Hey everyone, and welcome to 1% BTC. I'm your host Dom, and this is your other host David. And today we're going to talk about the bloodbath that's been going on, not just in the crypto market, not just in the Bitcoin market, but also the gold and the stock market. David, it's been a hell of a day, hasn't it?
It has been. It's been a roller coaster ride, but we're still here, and we're here for another day.
That's it. And look, when you've been through as many of these as David and I have, it's water off a duck's back. But we understand that for a lot of you, this kind of price action that we're going into, especially when you see something like this, can make your heart sink. So yeah, as you can see from this, a lot of red on that screen. Crypto market was down across the board. To put that in perspective, from Joe Consorti, he put together this nice chart. Across the board, it was the second worst day of the year for Bitcoin. We had a 6% drawdown. So the last time we had that was back in early March, you can see. So yeah, this really wasn't a good day for Bitcoin investors. And yeah, in terms of that price, we did unfortunately drop below the 100,000 price support. I said yesterday that it was possible, but yesterday I did say that if we did, I thought it would be short-lived. And you can see that almost within pretty much a couple of minutes, we started to recover. Now, I can see that when you zoom out, once again, I said this yesterday, year to date, we're still up 8%, which is a relatively good return. And for the year, 46%.
That's incredible for the year.
It is incredible.
You know, Plan B tweeted earlier, saying earlier that he ran a poll of, you know, what percentage of people said that it would return back to below 100K. And this was about 6 months ago, when Bitcoin was in the 120s, or you know, it was 100K seemed unimaginable, and 62% of the people said that we would return back to below 100. So I personally didn't think we were going to reach it because it was such an important support level, but here we are.
Well, the market always likes to go against the consensus belief. And generally, fear tends to be a stronger emotion in a lot of cases than greed, in my experience. So when fear really does grip the market, and especially when it's due to a large number of macro events, it can tend to get the better of people, unfortunately. But as I said, for the year, we're still up 46%, which is still astounding, to be frank, that we're still above this level. And as I said, we quickly rebounded. And for those of you out there that think that this can just happen to Bitcoin, as we said yesterday, gold was down on the day as well, almost 2%, which for an asset that's 10 times the size in terms of market cap, over 10 times the size, a 2% move in gold just shows you that there was far more money moving out of the gold market than there was the Bitcoin market.
Yeah.
And year to date, and over the past year, we are still up more than 1% higher than gold, even though gold has taken all of the steam out of the room in terms of the mainstream media saying, oh, should have gone for gold. You're actually still would have been better a year ago today to have bought Bitcoin instead of gold. So look, David and I always try and be honest with our viewers as to around exactly where we are. The truth is that we are down around 22%, 21.7%. To be honest, in the past 29 days, we've dropped from 126,400, which was the price peak, down to around 99,000 for that short time that I mentioned earlier. The problem here, or at least the thing to watch out for our viewers, is the short-term holder cost basis. So this is anyone that's held Bitcoin for less than 90 days, is around 107 to 108,000. Now, obviously, we've dropped below that. Now, historically, when we trade below this threshold, it can signal capitulation or a late stage correction. Now, what it tends to mean is that the risk here is that short-term sellers tend to be a lot more, or the belief is that short-term holders, I should say, tend to be a lot more focused on the actual dollar value of their asset. They're not necessarily in it for long-term holds, and so they're more likely to sell. So when we say capitulation, the fear is here is that the price drops could continue. Now, another one to keep an eye out for the 200-day and 50-week moving averages, sorry, and 50-day moving averages. Now, the 50-day moving average was at 112,000, and the 200-day, which is a better line of support, was around 104,000. Now, what you can see from the chart is that we've had a potential death cross where we've actually dropped below that. And the last time Bitcoin traded below its 200-day moving average was mid-2022. So you can see that this is something that is has put, as of today, sorry, as of the past couple of days, we've moved out of a month-to-month accumulation phase. Now, if you look at these red dots on the chart, you can see that when we did drop below that moving average, however, it was right before a recovery. So we could potentially, this could be a make or break moment for us. If the price reclaims above 110, 113,000, it would invalidate that breakdown and confirm renewed momentum and trend re-entry. So all to play for.
It's interesting to compare that to the back in October or November of 2021, where it did break down below that with the death cross, and then it actually touched it back up again and then went further down. So that's when you made it's a make it or break it moment where it can go either way, as long as it kind of, yeah.
Absolutely. And look, when you actually go through that, where it breaks in 2021, you're then looking at a sort of around a year, if the cycle repeats, of a sort of downward market before we then breach again the 200-week moving average. Sorry, 200-day moving average. So that is something to keep an eye on. But as I said, as long as you haven't over leveraged yourself, as long as you fully understand what you're investing in, then these are just great opportunities to continue to stack more sats, in my opinion.
Yeah. Right.
So look, the question here is it just short-term holders and retail capitulating? Now, we have seen movements within BlackRock's wallets. There has been some indication that this has been selling, but obviously we'll have to wait till tomorrow until the official statistics come out as to what the day-on-day volumes were and what the actual trading was. This is from certain organizations that look on chain and try and track the wallets. Now, simply moving holdings from one wallet to another doesn't necessarily mean that they're selling. It could just mean that they're reorganizing into different wallets. So I don't want to jump to conclusions, but obviously large entities like BlackRock selling significant amounts of Bitcoin, and in this case Ethereum, you can see from the chart, could explain some of the movement that we had in that 6% drop over today. So bet you're all asking, how bad can it get?
Yeah.
So Bitcoin falling from 126,000 down to 99. Obviously, we've had a slight recovery at the moment. I think we're at about 102, 103. Now, historically, Bitcoin corrections have ranged from about 30% to about 87%. So we're still nowhere near even the sort of the moderate kind of correction. Now, they tend to average around 50%. So major drawdowns in 2018, we went down 83.6%, 2013 to 15, 86.9%, and 2021, 51.1%. And that was obviously, of course, after Tesla decided to sell a number of their holdings. Now, what I would say is that even in strong bull cycles, in strong bull markets, we often do experience multi 30 to 40% dips, typically followed by new all-time highs. So this is all part of the course. It happens. You have to get used to it. We just want to be realistic with you about the kind of expectations around how bad any kind of dip can go. But at the moment, as I said, we're still below the average. We're still above the average. A 22% dip is nothing compared to the average of 50%.
Excellent.
So what are some of the reasons for it? Well, the US government has now officially entered its longest ever shutdown. It's been going on for 35 days. Now, what you can see is that what surprised me and why I love this chart from the Kabasi newsletter, is the Trump administration promised when they got into office that they would cut spending. They implemented the Department of Government Efficiency, ironically named Doge, with arguably the best businessman on the planet, Elon Musk, purely there to cut costs. Despite that, just since the shutdown began on October 1st, 2025, and I don't know why I'm laughing, it's most certainly not funny, but the US government has borrowed $600 billion worth of debt. So to put that in perspective, that's $17 billion per day. Now, you may think, well, how much is that? The brain struggles to fathom how much that is. Well, if you start to put it into context as to when Trump first came into office, the debt was around 36 trillion, and the Republican government has added over 2 trillion. So they've increased almost 2 to 3 trillion. So another way of looking at it is they've increased the debt just in the past year by around 5 to 10%.
Wow.
Which is staggering.
Wow. That's incredible. And that's just going to get higher. Is there any indication as to when the shutdown will kind of lift?
No. Well, I've actually got something on the next screen about that. You, as always, David, you predict my questions.
There you go.
Slide. So, obviously, this was the 14th time that Democrats have declined to reopen government. They obviously want some concessions. The Republicans are unwilling to offer them, so we're at a stalemate. Now, obviously, in terms of reliable sources to turn to, I tend to trust where people are putting their money. That's why frequently on this channel you hear me talk about applications such as Polymarket. The general consensus, as you can see from this, is that around 50% of those betting their money, 54%, say that it's going to be after November 16th. So that would be another, what is it today, the 5th? That would be another 11 days, but it could potentially go until December 1st.
Wow. Wow.
Yeah. Be absolutely staggering and detrimental to the US to do that. The interesting thing is that obviously the US government, and I haven't got a slide about this, but obviously when any government has a shutdown, it basically cuts off funding for all non-essential government services. Now, the US President Donald Trump is still pressuring the Fed Chairman Jerome Powell to continue to lower rates. My question is to them is, considering that government reporting is on hold essentially until this government shutdown ends, how on earth can you, with any meaningful data, agree to continue to cut, to agree to either cut or not cut without having that data at your fingertips?
That's true.
You're basically cutting into blindness. Maybe there's something I've misunderstood, but it seems to me like you're kind of shooting in they're going to be shooting in the dark if they do that.
So if the government is in shutdown, then all funding for programs is cut. So wouldn't you see a decrease in government spending?
You'd think so, wouldn't you?
So,
Begs, I'd love to be able to answer that as to what's happening with that. I don't think we've got the exact figures on where that funding is going, but we can definitely look into it. I definitely have that as a question myself, because surely you would hope that there'd be some savings.
But I'd imagine also that the employees, government employees, are just furloughed, so they continue to be paid their salary, their kind of big salaries, but they're just at home. So unproductive kind of government offices that are just doing nothing. So that's probably where the costs continue to spiral.
True. I think we should definitely look into that, because I find that quite interesting. But either way, not good, and it most certainly doesn't help the momentum in the markets or the general feelings that investors have. So, as if I haven't given you enough negative news today, the question that we were asking was, who is doing the selling? Now, long-term holders are continuing to sell. So a long-term holder is anyone that has held Bitcoin for over 9 months. Now, long-term holders have dumped a staggering 400,000 coins in the past 30 days. To put that in context, that's around 2% of the supply. So if Bitcoin can stay above 100K, which it's still despite its minor drop below that earlier, while these whales are unloading hundreds of thousands of coins, we can only imagine what will happen when that selling stops. Now, you can see that those whales are selling into strength. There's things that we can look at on chain which indicate the type of whale that they are. The good news is, based on the UTXOs, it doesn't, and I won't go into detail about how, but based on some of the things that we see on chain, it indicates that it's not the, it doesn't tend to be, we don't believe it's the ETFs or the treasury companies as a whole. What it appears to be are those quote unquote OG whales who've decided to take some lifestyle chips off the table. So as we mentioned yesterday, bought at $10, you've now got $100 million worth of Bitcoin. Maybe you decide to cash some in once it passes that 100,000 psychological price point.
Yeah, I know. I did research that there was a wallet that was dormant since 2011. There was a wallet that had 10,000 Bitcoin that moved and that sold their 10,000 Bitcoin. So when you talk about long-term holders, that's a great example.
Absolutely.
Yeah.
And kudos to that gentleman or person for holding on for that long.
Yeah.
It's, imagine watching your wealth go from pretty much a couple of hundred or a couple of $1,000s to multi-millions and saying, I'm not going to sell any for 10 plus years. I mean, you've got to have cojones of steel. The one thing that I do want to mention this, because it made me think about this, everyone talks about the negative side of these OG whales, these really, really long-term holders from, say, pre-2015, pre-2013, selling into the market. There is one positive that no one really talks about, and that is that this is in many ways a good thing for the Bitcoin network as a whole. There are only two ways, as I said, that you can, in a previous video, that you can seek to get hold of Bitcoin. You can mine it, or you can buy it off someone. Now, every time these OG whales who have huge amounts of Bitcoin sell, it helps provide liquidity into the Bitcoin network, and it helps ensure that those coins can now be bought up by others within the network. So it actually helps distribute the coins, provided that they're not all gobbled up by these other large entities, and we're just trading Peter for Paul, or apples for oranges, I should say.
Yeah.
So there is a positive. I think in the long run, this will be good because it will mean that newcomers to the market and smaller entities like myself and yourself, David, will be able to gobble up more coins at cheaper prices.
That's a really good point. It makes it attainable for the retail investors wanting to go in. And as we've seen, even though it did dip below 100K, it was quickly gobbled up. You know, then we went back to 101K and then 102K, and then, you know, it still continues to plod along.
Absolutely. And if you look at these selling dips in the market, I mean, they've been repeated and constant all the way from sort of the $55,000 level. And yet the market has just continued to swallow them up, just relentless buying of coins from these other entities. So I think in many ways it's a good thing. And don't forget, these large entities, these OG whales, only have so much Bitcoin they can sell. It is a one-off event. That will occur as certain price points are reached. Once that gets swallowed up by the ETFs, by the crypto treasury, by the Bitcoin treasury companies, by retail, it will stop. So unfortunately, some noise that personally annoys me quite a bit, and that is that one of the most pronounced treasury companies, I believe they're the largest treasury company in France, they're a chip maker called Squans, has sold around a third of their Bitcoin holdings. So they sold around 970 Bitcoin and reduced their holdings to around 2,264. Now, the reason they did this, as far as I can tell, is the sale cut their debt in half from 189 million to 94.5 million. Now, this for me is something that may have helped Squans in the short term, because obviously they've cut their debt in half, But to me, it's a death cross for any treasury company in the long run. And this was reflected in their share price. Their share price fell 16.6% after the announcement.
Wow.
And it's because this move highlights that, although the move highlights that these treasury companies may be under strain under a volatile Bitcoin price, the whole point of having a treasury company is you adopt the Bitcoin ethos. It's that you never sell. It's that you hold on. Why would I invest in a treasury company with the intention of growing my Bitcoin per share if I believe that they're going to basically rug pull me and at any point get rid of their underlying Bitcoin for fiat? I wouldn't. So I think this is a foolish move on behalf of Sec1 Communications, but we'll have to wait and see.
Mm-hmm. Interesting.
So, other big reason. Now we're going to move on to stocks. Now, obviously, we haven't really talked about stocks yet much on this channel, but obviously, considering today's events, it's definitely worth talking about. Now, the stock market was hit hard across the board. Nothing huge in terms of the downsizes, but obviously, we want to talk about some of the things that are actually happening in the stock market and why some of the fears are there beyond the crypto market. Now, the S&P equal weighted to market cap ratio. Yeah, so this is the percentage of the market cap that each stock takes up. Has basically dropped to 1 in 10. Yeah, and that's the lowest in 22 years. It signals basically extreme market concentration. And it's pretty obvious to anyone who's picked up a newspaper or read the news or even asked ChatGPT in the past couple of years what the concentration is around. It's, of course, around a handful of mega cap tech companies. So your Nvidia's now valued over $5 trillion. Your Microsoft, your Apples, they are basically carrying the entire index. Now, last time we saw this at similar extremes was before the dot-com crash and also before the 2008 financial crisis. Both times were when the market breadth collapsed. So the cream sort of flowed to the top, but things got over tightened or concentrated in very small number of companies. And what it really highlights to me is a top-heavy illusion. So dependent on it's the whole of the S&P and what people believe is the some of the best 500 companies in the world is actually dependent on a couple of AI and tech companies and based predominantly on their euphoria and the euphoria that surrounds them. Any thoughts, David?
No, it's just I'm just looking at the dot-com bubble and the great financial crisis, and it's just it's shocking. I think there's another chart it's the Warren Buffett. It's a Warren Buffett indicator that basically says whenever you have a huge concentration of the top, like 20 caps, 20 market cap, 20 stocks by market cap, you're just destined for a crash, and it's created its own bubble, and where this concentration and centralization of wealth just creates a need for a reset in the market. And that's what we're seeing. All the news, they're all saying that we're headed for a recession that's greater even than the Great Depression. And I don't know how much of that is fear mongering or if there's truth in that, but I just can't imagine anything greater of a fall than the Great Depression.
Absolutely. I mean, it's pretty terrifying, and we don't know what would kick off that Great Depression. It could be a number of many factors, which we'll cover on the channel. But what I wanted you to take out of this slide is that historically, narrow leaderships like this have preceded a sharp market correction, because capital will eventually rotate out of the overloaded leaders once growth starts to slow and liquidity tightens. So let's look at two other charts quickly, just to sort of hammer this home. And I really like these two. I think they were great ways of putting it. So cumulative return of the Mag 7 over the past 10 years is around 14% per year. For the other 493 companies, it's around 2%. Sorry, let me put that in. Sorry, let me start again. Since 2015, the Magnificent Seven stocks have delivered around 1,200% cumulative return. The other 493 that make up that S&P 500, only about 100% over the same time period.
Wow.
So that means that the Mag 7 outperform every other stock on a ratio of about 12 to 1. Now, to put it another way, as you can see in the first chart on the left, the 10 largest companies, so not just the Mag 7, but the 10 largest companies in the S&P 500 account for about 43% of the market cap and 30% of the earnings. So it's absolutely astounding.
That's a huge concentration.
It really is. And on that note, do you know who has who's sending warning signals about this? Have you ever seen the film The Big Short?
Oh yeah, Burry, right?
Yeah, Michael Burry. So for those of you that don't know, Michael Burry is famously known for calling the 2008 crash, and is now betting. He's now betting against the top US AI stocks, particularly Nvidia and Palantir. Now, Burry goes by the name, not sure why. I'm sure one of you will tell me in the comments. He goes by the name on X of Cassandra BC, and he's been posting repeatedly some of these charts. So I just wanted to break these down. Now, his move comes as, obviously, as we talked about in the previous slides, AI stocks have hit record highs, and obviously that's raised fears amongst us all, as David has alluded to, about an AI bubble. Now, Palantir fell 6% overnight, showing that many investors are nervous. And just to put this in perspective, what Burry has probably seen is that Palantir trades at 250 times earnings. I'll say that again, 250 times earnings compared to Nvidia, which is 33. So even trading at 33 times earnings, or Microsoft's 30 times earnings, would be a red flag. But 250 times earnings arguably is a massive bubble. But maybe there's something about Palantir that myself and Burry are misunderstanding, because many experts are disagreeing, and others think that he's calling the top too early. But what is he focusing on? So this first chart that I know David and I have spoken about before is a great one for showing that, or for helping us question. Essentially what Burry's getting at here is he's saying that this money that we're seeing flow around the tech space within the US between companies like Microsoft, OpenAI, Nvidia, Oracle, Intel, AMD, etc., is basically just a reflexive circle. It's just the same money sloshing around to make the other companies look more profitable. So Nvidia and OpenAI control most of the money within AI. So they connect chips, software, cloud systems, etc. Nvidia has a market cap of 5 trillion, and OpenAI, last time I checked, was about 500 billion, I think. But essentially what they keep doing is they keep just funding each other. They keep basically taking one's spending becomes another one's profits, and it creates a feedback loop. Likewise, Oracle, Microsoft, and AMD are key partners. So they're making huge deals for chips, cloud services, etc. And the system is basically feeding on itself. Growth is reliant on constant AI spending to keep going. A way I think that Burry is thinking about it is it's kind of like a Ponzi scheme. Just keep the money moving around, and that way, if I earn $100 and I transfer it to David, David can say that he's earned $100, and then he transfers it back to me. I can say that I made another $100. That seems to me what Burry is getting at, I believe, with this is that it seems to be what's going on with the tech sector at the moment.
So essentially what's happening is, like, to use the examples of OpenAI and Nvidia. So OpenAI, say, for example, doesn't have enough money to buy GPUs from Nvidia and hardware. So what Nvidia does is it, say, invests money into OpenAI and takes a stake, a very small percent stake, and then OpenAI would use those extra invested funds then to buy more equipment and hardware from Nvidia, right?
Correct. Yeah.
And rinse and
Or they
repeat.
may go, that's it. Or they may go and buy it from AMD, or it's basically the same money just washing around the same sort of 10 to 15 companies.
Yeah.
So that they all look good to on paper. And it's funny because after I read this, and obviously Burry published this in the past day or so, what was the next announcement that came up? Amazon, who wasn't even on this chart, announced its $38 billion partnership deal with OpenAI. So even when Burry posted this, taking this out of Bloomberg and posted it less than a day ago, it's already outdated. So, yeah.
That's crazy.
Yeah.
Wow.
So let's just quickly cover off these other two charts. So on the left-hand side, Burry's thesis and what he's getting at in this slide, I'm not sure if you can see it, but it basically shows Amazon, Alphabet, and Microsoft. But he's basically showing that the major cloud companies are slowing down. Amazon's growth dropped from 36 to 17%, Alphabet from 45 to 29%, and Microsoft down from 22% to 20%. Despite this slowdown, however, AI hype, so this hype that AI is going to be revolutionary and change our world, which I do to an extent believe, keeps pushing the stock prices of these companies higher. So it's separating their valuations from their real earnings.
Mm-hmm.
Now, the drop in growth shows that markets are saturated while AI spending is peaking, is another way to think about it.
Mm-hmm.
So spending more, but earning less. Now, on that spending, that's what this second graph goes on to. Now, this shows tech CapEx, so capital expenditure, is exploding. So tech spending is going through the roof. It's grown nearly 20% per year. And the last time we saw this was like during the dot-com bubble. Companies are overspending on AI infrastructure. So the chips, data centers, the cloud infrastructure, etc. And they're doing this purely to chase growth, which is exactly what happened between 1999 and 2000. But that was right before the profits collapsed. Because if we go back to our previous screen, eventually the world catches on to what they're doing, no more liquidity can be found, and everything starts to break. Now, there's what you can see from the chart is there's basically a massive gap between the AI spending and the tech earnings. So the lower chart, the yellow color line you can see is the earnings, and the green line is the and the green line is the AI spending. So their spending is massively outpacing any growth that they're seeing.
Mm-hmm.
Now, obviously, OpenAI has got to come to the party because Sam Altman has seemingly bottomless pockets. But essentially, OpenAI signed a $816 billion deal. $816 billion worth of deals, I should say, this year, with companies like Stargate, Nvidia, AMD, etc. So they're on that flywheel that we went through previously as well. Analysts expect that when they IPO, there'll be hype around it and possibly $1 trillion valuation.
Wow.
But just want to pose this question to you. OpenAI's pockets aren't limitless, or at least they shouldn't be. So its growth, in my eyes, and correct me if you disagree, David, depends on non-stop funding for chips, data centers, cloud power, etc. So if they're spending this much, 816 billion in a year, like, when do they run out of money?
Mm. Why do you say it's dependent on non-stock money to be able to fund its operations? But is it,
Sorry,
you
non-stop
said,
money.
yeah, did you, maybe I misheard you. So its ability to be solvent is dependent on its ability to pay its operational costs, right? So if they spent 816 billion in the past year, in just deals.
Well, I suppose where's the money coming from is my question. Because I don't believe that. I mean, is OpenAI that profitable at the moment? I don't believe so. And just to put it in context, $816 billion of deals made within a year is a staggering amount, absolutely staggering. And so I would just query as to, are these deals going to provide the fruit that Sam Altman is investing in? Are they going to lead to these revolutionary changes in a market which is becoming more saturated with competitors? You've got Grok, XAI, you've got Gemini. So is the juice going to be worth the squeeze? And what happens if the deals don't pay off?
Yeah.
So obviously that was a lot of negative views. I want to just say to our viewers, David, well, let me ask you, how are you feeling at the moment after going through that?
Yeah, it's a bit, I think I'm concerned with the correlation of Bitcoin and the wider markets, right? If there's so many, we have a government shutdown, right? We have increased concentration of AI stocks in the Mag 7 in the stock market. And it's waiting for the bubble to burst, the AI bubble to burst, right? So what does that mean for Bitcoin? And, if we're going to see a depression, or a depression-like kind of a correction in the markets, what does that mean for, I know the hardest assets are great hedges against these crashes, but in the short term we're going to see a lot of pain. That's what this is kind of heading towards. Would you agree?
Yeah, I would say that there's different scenarios as to what plays out. So we can guarantee that a black swan or multiple black swan events will happen. We can't guarantee what the trigger is. Obviously, in 2000, it was the tech stocks that triggered the sell-off. In 2008, it was the housing market and over-leveraged mortgages. Now, we can't say what is going to trigger the next recession. What we can do is basically ask our viewers and ask ourselves to question, where should you be putting your money? Now, the thesis for Bitcoin is that if in response to liquidity drying up, if in response to a massive market crash and people's pensions being tied up in these stocks, these same tech companies, etc., if all assets are going down, what do you expect governments to do? My personal thesis is that I expect them to print. Whereas David said, the big winners of that are going to be hard assets, gold, Bitcoin, silver, things that can't be printed, things that have understandable and to some extent fixed supplies. Now, with regards to what happens in the short term, Bitcoin, unlike gold, is still treated as a risk asset by many. And so you could still see higher drawdowns in the event that there was some 1929 Great Depression style sell-off. My theory, though, is that Bitcoin would recover because its characteristics would lead it to recover. So as more money went back into gold during the recovery phase, you would start to see those same people learn about gold and learn about the qualities of gold, would inevitably, in my mind, be drawn to Bitcoin because it has a number of the same characteristics as gold, but it's superior in many, many ways.
I know time in the market beats trying to time the market, right? But there's still a part of me that says, you know what, if we are just reaching above 100K for Bitcoin is a tremendous achievement, huge. And I mean, why, maybe we can cover this in another video, but what is the strategy if we're headed towards a short-term correction of, say, we've seen corrections of between 20% and 85% in previous, even within strong markets and bull markets, we've seen huge corrections, as your slide indicated. But are there opportunities to just, I guess, what's the strategy during these market?
So you're looking for a short-term strategy, or being able to capitalize in the event of a sudden harsh drawdown. What I would say is, I think it's pretty simple. you don't know what the overall outcome is going to be. So you need to make sure that you have some liquid cash available. Now that cash could be, if you don't want to hold physical cash, you could hold gold, because gold has typically performed well. I personally would hold some cash on hand. How much is up to you. Mostly I would think anywhere between 5 to 30% is generally within a good range. That enables you to make those quick decisions. But obviously if you opt towards the higher end of 30%, you've got to bear in mind that this up market, this bull market, could continue to go on for a number of years despite everything. There's been calls for the past 10 years, more than that. There were calls pretty much 2 years after 2008 and 2010 that the market would crash. Now, if you'd stayed 30% in cash at that point, you'd have missed out on a huge amount of gains. And that's even if you just went into tech stocks, let alone something as risky, quote unquote, risky as Bitcoin. So what I would say is, if you're worried, most certainly keep some cash on hand, but just not too much, because you might miss out on the upside.
Yeah. Well, look at Buffett, as we shared during a previous video, is he has 320, I think 8 and counting $billion set aside in cash. That's his largest percentage of cash holdings in his history, right? So he's typically held between 12% and 20% max. This is kind of doubling that kind of amount of cash holdings. So yeah, I think that's a smart strategy.
Yeah, I think so. And as I said, if you're not a fan of cash, then you could look for other assets which provide a similar kind of safe haven side, as well as providing you that liquidity. But as David said, we can talk about that in different in follow-up videos, because I think that's important to get into. So I understand that was all pretty heavy. Obviously, days like today, whenever you see drawbacks, are never fun. But obviously, I just want to quickly touch on some of the silver lining for Bitcoin. Now, spoken about, considering we were just talking about AI and some of the AI deals that are going on, I've got one more for you, but it's actually pretty pro Bitcoin. So Microsoft is converting 200 megawatts of Bitcoin mining sites in Texas into AI data centers. So the reason they're doing this is AI hosting makes from best estimates, 500 to 650K more per megawatt per year than Bitcoin mining. So basically, by doing this, what they're getting is cheap power and renewables that make it. Sorry, the mining facilities offer cheap power and renewables that make it ideal for AI in the same way they make it ideal for mining operations. Now, you may say, well, how is this good if the computing power, these ASICs, these miners, are getting rediverted away from mining Bitcoin to actually being used to power AI? Well, as miners shift towards AI hosting away from a purely mining-based business model, that means that fewer Bitcoin are being sold to cover their electricity costs. Because don't forget, as I just said, the AI is arguably more profitable than the Bitcoin miner. Now, what that actually means is that they don't have to sell as many due to electricity costs, which basically eases sell pressure on the market. That helps in turn stabilize the hash rate of the Bitcoin network, which in turn improves miner profitability. So it's basically, in the long run, it will support long-term price strength in the market.
Interesting.
Yeah. So I really like it. And what I also like is, I think there's two big narratives, and obviously I've just spent some time talking about AI and talking about the risks in it. But one of the things that David and I have spoken about at length is that we think there are two big narratives in the world at the moment, or two big opportunities. The first is Bitcoin, and to a very lesser extent, crypto. And the second is AI. We believe that the time that we're living through now is when it comes to Bitcoin, a once in a species event, and in terms of AI, a once in a generational event. And so there will be huge opportunities within both. And I love to see synergies between the two, because it will help anytime that you see AI companies making deals, especially companies as large as Microsoft, in any way get involved, even if it's indirectly with Bitcoin. It's good for the market, in my opinion. So next thing, BitKey has basically had a bit of a breakthrough. So just to put it in context. So BitKey is a self-custody Bitcoin wallet developed by Block. So Block was formerly known as Square, and that was a company formed by Jack Dorsey, who, for those of you that are old enough to remember, is the former creator of Twitter, or former CEO of Twitter, and he is now a Bitcoin maxi. Now, he's basically dedicated his life from now on to basically making sure that Bitcoin becomes the pristine collateral of the world and the world's leading financial system. Now, the BitKey is designed to make holding and securing your Bitcoin simple, secure, and accessible. Now, what they've actually done is BitKeys basically use their chain code delegation, which is basically a fancy piece of coding, but it lets users enjoy the safety of multi-sig, but without exposing their wallet balance or transaction history to BitKey or any third party. Now, without going into the technical details, because I'll be honest, they go even far beyond me, but from what I understand, this fixes a 10-year privacy flaw. So traditional multi-sig wallets had to reveal wallet data for coordination. BitKey's solution completely removes that exposure while keeping recovery simple. Now, if you look at the crypto market over the past couple of weeks, you'll have noticed a cryptocurrency called Zcash, which is a cryptocurrency focused on privacy, exploding in value. It's gone up astronomical amounts. Now, many of the criticisms of Bitcoin by crypto coin creators or privacy coin creators has been that Bitcoin isn't actually private. Every time you see an innovation like this, it goes directly against that narrative and helps falsify that narrative.
So with multi-sig, I never understood that about a multi-sig. So multi-sig stands for multiple signature
Correct.
in order to secure your wallet. So for example, if I had a wallet and I wanted to set up multi-sig, I would have maybe two other signatories on that wallet, on that hardware wallet,
Correct.
right? So in order for me to move any of my Bitcoin, I would need the agreement of these two other parties along with my agreement in order to move that Bitcoin, right?
Yeah. So think of it this way. You basically need, if I store my Bitcoin in cold storage or in a hardware wallet, and I don't know how to use multi-sig, I only need to remember one key. Now, the benefit to me is, obviously, I've only got to remember 12 to 24 words to basically go around the world, and as long as I've got an internet connection, I can access my Bitcoin from anywhere. However, there is some downsides to that. The biggest downside being that if I forget that key, or if someone attacks me and in some way convinces me to give up that key, I've then lost access to my Bitcoin. So I am the single point of failure. Now, with multi-sig, a wallet needs 2 or more keys to approve any Bitcoin transaction. So meaning, even if someone got hold of my key, unless they get approval unless they have the other key, they wouldn't be able to transfer that Bitcoin out of my wallet. Right. So it's adding extra layers of security. So even if one key is lost or compromised, the funds are still safe. So one of the biggest problems, from what I understand, is that anytime you've used multi-sig, you've had to give away certain pieces of information, such as the balance or the transaction history. Now, with BitKey's innovation, what they've made sure of is that you don't need to do that. So it just adds an extra layer of privacy to Bitcoin.
Amazing.
So really great innovation from BitKey. Now, going back to the price action, just a bit of good news. We are starting to see longs reposition. Mm-hmm. So high leverage longs are already coming back, with multiple new Bitcoin entries, from what I can tell, around the $102,000 to $103,000 level. So liquidation levels are compressed around 95 to 99K. In simple terms, what that means is that traders are defending that zone as a key level of support. Mm-hmm. What's also interesting, but just from when I went through this, is that their entry sizes, so the amount of leverage that they're taking, is between 10 to 40x. Now that tells me, or that indicates to me, that that's a really aggressive attempt to catch the bottom of a typical early rebound phase. So for instance, if I think Bitcoin's going to drop to 95 to 99K, and I think that it's going to instantly rebound, and I knew that for a fact. Well, rather than just going and buying Bitcoin at that low price, why not take on leverage at 10 to 40 times? And the more confident I am, the more leverage I would take, because I'd be so much more confident that the price would come back. So it's good that it's good to see so many longs come in at that price point, indicating high level support with such aggressiveness.
That's reassuring. Wow.
Yeah. I know you could do with some good news, so I thought I'd throw that in there. Likewise, a nice bit of on-chain news as well. So although the price action looks weak, a quick look at Binance withdrawals. So Binance is one of the biggest exchanges in the world. Binance withdrawal addresses are surging. So they basically jumped from around 340 to 418 this week. In simple terms for our listeners, basically what that means is more holders are moving their Bitcoin into self-custody. Now, why would you care? You would care because anytime a Bitcoin moves away from an exchange, you can use that to indicate that they're not intending to sell it. So we want that. We want more people taking their cryptocurrency off an exchange, because you would only move your Bitcoin to an exchange if you're likely planning to sell it. So this is another good thing, despite the somewhat terrifying price action and red charts. And another reminder, and David and I are going to continue to remind our viewers about this. We've spoken about the national debt. It surged to over $38 trillion, $3 trillion, $38 trillion. It surged by $3 trillion since Trump took office. That represents one of the fastest debt accelerations in US history. Federal borrowing is rising by $600 billion a month. So I know we already spoke about that, but I just want to remind you, as Lynn Alden says, nothing stops this train. That debt burden is going to continue to grow, and the only way out of it that I can see is that they're going to have to continue to print more money. It's going to increase pressure on the bond market and dollar stability, and it's going to reinforce what David and I have spoken about, which is the debasement trade, which is the narrative for hard assets like gold and Bitcoin to continue to benefit as fiat weakens.
It's a great reminder to say, this isn't going to abate anytime soon, and that this is going to continue to support the appreciation of hard assets. Excellent.
That's it. So I think we all need a reminder on days like today as to the core thesis of why we're in Bitcoin. Another one from Britain. Obviously, we mentioned Britain yesterday, where they were talking, Rachel Reeve was talking about putting a 20% unrealized capital gains tax on any person moving to another country or fleeing Britain. Now, it was actually lovely to see that Nigel Farage has basically acknowledged this problem and said that if the rich leave and the rich don't pay tax, then the poorer in society will all have to pay more tax. And that's because higher earning people inevitably pay more tax. So what does Nigel know? Well, Nigel is aware of this. Yeah, this is just 2024. It's not 2025. But what it shows is where millionaires are migrating out of in the red and into in the green. Now, as you can see, the main beneficiaries of millionaires, those countries which have had the most millionaires move to them, are the USA, Canada, the UAE, Singapore, Australia, surprisingly to me, Italy, Switzerland, and look where they're all coming from. China, India, Russia, and staggeringly, unsurprisingly, the UK.
Yeah.
So basically, what Nigel has said is Nigel Farage is the head of the Reform Party, and he's basically described it as a self-inflicted financial disaster. Now, here's what he's proposing. He wants to lure them back, these millionaires back to the UK with a £250,000, what he's calling it very patriotically, a Britannia card. So this is a 10-year residency, and what it will most importantly offer is tax breaks on foreign income for returning expats and investors. And I think this is great. I'm actually a big fan of this because, like Farage, I argue that Britain needs wealth, and it needs creators, and it needs entrepreneurs at home, and that if they leave, the poor are going to end up paying more tax, they're going to end up getting poor, and their quality of life will get worse.
I really like this strategy too, because it's rather than it being a stick, this is a carrot. Rather than penalizing the wealthy for migrating by taxing their assets of, I think the proposal was 20% of all their assets before to enable them to leave. What they're doing is they're attracting them, saying we'll actually give you greater tax breaks if you actually stay within this kind of domicile.
Absolutely. And it's exactly the same tactic that the UAE, Singapore, Milan, Lisbon are all doing to attract the best talent or the wealthiest individuals. Because every millionaire that moves to your country is another millionaire that brings income, brings jobs, arguably, brings tax revenues, is going to spend within your country. So I don't see why the UK, as arguably what once was, if it the financial hub of the world, isn't encouraging these people. Now, you may say, well, okay, that's great. You want to encourage millionaires to stay in the UK, but why do we as Bitcoiners like this? Well, Nigel also had this to say this month, which was he pledges to bring crypto in from the cold and stop work on potential digital pound. It's two really important things there. Obviously, David and I have touched on the idea of a CBDC. We know the European Union is pressing full steam ahead with their digital euro. Unfortunately, the Bank of England is pressing ahead with their digital pound. Nigel has pledged to stop that in its tracks, saying it's not only undemocratic, but it also goes against Western values. And he's also claimed that the UK, as I've just said, being for many, many centuries the financial hub of the world, needs to actually embrace crypto, needs to embrace the qualities of Bitcoin, and needs to use those to become that financial hub again.
Right.
So yeah, that's good. And the good news, I'm not supporting or endorsing any political party here. I'm just going on what would be arguably best for Bitcoin. Is Reform are currently leading in the polls as of yesterday with a 27% lead. Finally, a little bit of just let's call it self-soothing or cope. I just wanted to put together some of the David and I always say, when we look at any investment, we tend to focus both on the macro side, but also on the micro side. And by that, I mean the intrinsic value of the asset we invest in. Money is made when you purchase the asset, not when you sell the asset. Meaning, if you've done your research, if you understand what you're investing in and you understand what you hold, then the likelihood that you're going to make money is almost assured. If you don't understand those things, or if that thesis changes, or if you don't keep track of whether that underlying thesis has changed, then you're likely to lose money. Now, the great thing and what I'm trying to highlight from this is I'll just take you through these points, because what I'm trying to get is, despite everything that I've taken you through and that David and I have spoken about, Bitcoin is getting stronger than ever. So forward annual inflation, this is the new Bitcoin coming into supply. It's 0.82% a year. To put that in perspective, the target inflation for most central banks is 2%. So we're already less than half of that. Realistically, the real inflation is anywhere between, when you take monetary debasement and money printing into account, and the fact that governments tend to massage their stats, is anywhere between 3 to 14%. So 0.82% is amazing. Another way of looking at it, the inflation rate for gold. Yes, gold does have an inflation rate. It can be mined. More is mined every year. Is around 1.6 to 2% per year. So we're already half that of gold. The next thing is, at the next Bitcoin halving, which is less than 3 years away, that annual inflation will be cut in half. It will go down to 0.4%, and then it will be 1/4 the inflation rate of gold. It is going to continue to become scarcer. Bitcoin nodes that secure the network, obviously the more of those nodes that we have worldwide, the better. Those nodes continue to grow. I encourage all of our listeners to go set up a Bitcoin node. It's a quick thing to do. David and I can help talk you through it. But the more nodes we have on the network, the more secure the network is. Next thing, the ETF holdings. As we spoke about yesterday, the ETFs, the big players, Wall Street, the big companies, the major buyers, BlackRock, your Fidelities, and all of their customers continue to accumulate Bitcoin. Yes, we've seen a bit of selling today, but on the whole, they are buying Bitcoin at a rigorous rate. Next thing, the uptime. We've all seen over the past few weeks that we've had major downtimes with AWS, with Microsoft product offerings. With Bitcoin, despite this, in the whole time that it has been up, it has had almost 100% uptime. That is the benefit of relying on a decentralized rather than centralized network. MicroStrategy and the Bitcoin Treasury companies continue to accumulate Bitcoin. They now have around 18% of the current supply and 17% of the total 21 million Bitcoin. This is good. We want more companies adopting a Bitcoin standard. The more that do, the more that they can incentivize others to do so and spread the word of Bitcoin. Mining stats, the hash rate of Bitcoin. As I said, the higher the electricity expenditure, which is here in exahash, is the more electricity that is spent, the more that Bitcoin is linked from the digital world to the real world, the more proof of work is needed to secure the network. The more secure Bitcoin is, the harder it is to perform a brute force attack. And finally, the future Bitcoin supply on the right-hand side, which we've kind of touched on. Just a reminder, 2026, next year, 95%. That's 19 out of every 20 Bitcoin will have been mined. In February 2035, 99% will have been mined. So the next 1% will take another 105 years. At that point, Bitcoin is essentially fixed in supply.
Wow.
So just a reminder to our viewers, and I think for you, David, because you seemed a bit shaky on this call, Bitcoin is good. Bitcoin is good. And I just wanted to end on a light note. My favorite article that I've seen all week. Obviously, we talk a lot about different indicators on the stream. This was my favorite and a great piece of work by BuzzFeed. Shout out to you, Jake Farrington, because you're clearly not getting paid enough to write things of this standard. But this is 19 reasons why strippers think we are absolutely, without a doubt, not just absolutely, but without a doubt, in a recession right now. Interesting read. I won't go through all 19 reasons, but essentially, the one that I wanted to point out, the one that caught my eye, was the fact that most of the strippers, and I believe this was undertaken in Las Vegas, said that younger generations prefer online platforms like OnlyFans, making real-world clubs less popular and less discreet. So even the strippers are getting replaced by AI.
That's great. Yeah, I know I started a bit shaky, but this I think this news roundup really helped. I mean, I've been involved in Bitcoin and learning about Bitcoin for the past 8 years, and I've gone through really terrible bear markets where I've lost, I've just experienced huge downturns, and it's helpful. We are in a bull market right now, and these dips are temporary, and but we're still, human nature is to be swayed by emotion, and especially in the trading environment or the investing environment, when it's money, and there's a psychological element, and it really helps to learn what's really happening in the markets, getting back to the facts and the logic of what's playing out, rather than just seeing what the kind of reaction and the hype is talking about. Because in a way, I mean, Warren Buffett's strategy of just not looking at what's happening and actually disconnecting from any digital kind of device is probably the best course of action. To sit it, leave it and wait, and just don't revisit it until, months down the road, or even years down the road.
Absolutely. I mean, it's days like today that they've got the famous saying to go outside and touch grass. All the work has been done up front. If you've done your research on what you're investing in, whether it's Bitcoin, gold, stocks, real estate, no matter what it is, if you've done your research and you can list the 30 reasons why it was a bad idea and still go through with it anyway, because your thesis is still strong, then short-term price action shouldn't matter to you. And as I said, today I bought a small amount of Bitcoin. I continue to do my dollar cost averaging strategy where I buy more as the price falls, and I've done that consistently for an extended period of time now. So it's hard, and I think you raised just before we go, I think you raised a really good point about it's harder when it's your own money on the line.
Mm.
Than it is if you've ever used one of these trading apps, or if ever you've played Monopoly. I mean, actually, Monopoly is a bad example because so many people get so angry over it. But it's different when it's your own money online. That's something called loss aversion. People are actually more likely to not invest because they're scared of losing a dollar compared to the idea and the happiness that gaining a dollar would bring. They'd much rather just not lose the dollar that they've earned. And I think that part of it is you will always need to, one of the things that David and I will try and help you with to understand is that you will always need to undertake risk, have some level of risk and acceptance of risk, obviously within your risk framework, but some level of risk acceptance in order to make money from investing. Mm-hmm. There's no way to avoid it. Every asset carries risk. And yes, even cash, because of inflation and debasement, carries a level of risk, whether you know it or not. So you need to get comfortable understanding what those risks are and knowing that you have to put money on the line in order to make money.
Mm. And that's why the name of our channel is 1% BTC, right? We're not saying to go all in. It's very much just if you can allocate 1% of your investable money into this emerging asset class, this has an opportunity for asymmetric returns, right? So the upside far outweigh the risks of losing your capped 1%, right? And I mean, Bitcoin has existed now for 16 years, and it's highly unlikely that it will trend down to zero. Highly unlikely. And I'm not going to say it's never. There's never a possibility of that happening, but if you can just test out with 1%, you opening yourself up to some tremendous opportunities.
Absolutely. And I think if you're feeling nervous about when you get downturns like this, which, as I said, was only 5%, we're only 20% down from the all-time high, maybe you've got to ask yourself whether you've over-allocated yourself or stretched yourself too thin. And on that note, I want to basically thank David for the conversation today. Always good seeing you.
You too.
Any final comments for our viewers before we switch off?
No, I think this was a great roundup, and I'm looking forward to the next one.
Excellent. Me too. Well, on that note, guys, I just want to round up by saying, don't forget, none of this is financial advice. We are not financial advisors. We instruct you to go do your own research and consult a financial advisor or fiduciary before making any long-term financial decisions. We're just two guys on the internet helping you get to your first percent in Bitcoin. And essentially, we just want to end by saying one thing. Most will miss it, most will mock it, and most will wait until it's too late. But the 1%, they act with conviction.
Be a 1%er.
See you later, guys.
Later. Bye-bye.